Hello, I'm Caragh, DeLuca, and today I'm joined with Ben Luedeke. And today we're taking a closer look at the state tax implications of the newly enacted One Big Beautiful Bill, or OBB, signed into law by President Trump, and we wanted to talk about what that means for the financial services industry. The final bill contained many extenders to the TCJ provisions, along with some revenue raisers and tax cuts. However, one of the key items that of interest to asset managers that did not end up in the final version of the bill was the pass-through entity tax provision, alternatively known as PTET. It was certainly a roller coaster ride with the original House and Senate bills. However, the enacted version of the bill did not contain any PTET limitations. Today, we're going to take a deeper dive into PTET. So I'll let Ben kick it off.
Thanks, Caragh. Let me provide a brief history of the pass-through entity taxes. They were really born with the 2017 Tax Cuts and Jobs Act, the TCJA. And what that bill did, it limited the amount that individuals could deduct for state and local taxes on their individual returns to $10,000, ultimately known as the SALT cap. Now, the SALT cap was a significant federal tax increase for many taxpayers, and the state governments agreed, really arguing that their constituents were being overburdened by not receiving the full SALT deduction. So in response, there was a handful of proposals floated around, but one that actually stuck and was validated by the IRS were pass-through entity taxes. So pass-through entity taxes are effectively a state income tax that is imposed at the partnership level. That state income tax is deducted by the partnership and flown through federal taxable income to the individual taxpayers. And in return for those taxes paid by the partnership, the partners receive a state income tax credit or some kind of income exclusion for those taxes paid by the partnership, effectively circumventing the SALT cap. Now, it all started with Connecticut, who enacted the first regime back in 2018. But as of today, the majority of the states that impose a personal income tax have enacted some kind of PTET regime. Now, there's been a lot of debate over the past 7 years on whether the SALT cap should be raised or not. But really, PTE taxes have gone under the radar. And that was until we saw the first draft of the One Big Beautiful Bill. So a quick recap of the One Big Beautiful Bill and where we ended up. So in the original version in the House, effectively, certain taxpayers were going to be denied any PTET deduction, including the lawyers, the accountants, and the asset managers. Although other taxpayers not meeting these definitions would be still afforded the full deduction. Now, once that bill went from the House to the Senate actually changed it. And effectively, they allowed any taxpayer to continue to receive the benefit of the PTET. However, the deduction at the individual level would be limited to 50% of those taxes paid by the partnership. Now, fast forward to the final Senate bill that was passed, then sent to the House, passed at the House, and ultimately signed by President Donald Trump, that excluded any PTE provisions at all. So really great news for any taxpayer who operates as a partnership. Now, one additional note is in the initial versions where there were limitation upon the PTET regimes, that would have also impacted any entity level taxes, such as the New York City unincorporated business tax, which has always been a deductible tax. So again, great news for taxpayers operating through partnership. Now, one last item is whether the IRS will issue any additional guidance. There was a notice issued back in 2020, effectively blessing the PTE regimes, and it said that regulations will be forthcoming. However, as of today, we have not seen any further guidance from the IRS. So let me kick it over to Caragh to talk about some additional state considerations.
Great recap, Ben. So as mentioned before, a majority of the states have enacted their own PTET tax. There are a handful of states, however, that have tied their effective date to their PTET tax to the original sunset date, which was 2025. So those states will require some kind of legislative action to reenact or extend their PTET tax. Good news is California has recently extended their PTET to 2030 under a bill signed by the governor on June 30th. And Virginia recently extended their PTET to 2026. Unfortunately, Oregon was not able to pass a PTET extension during recent legislative session.
So, Cara, you mentioned the California bill. So, in that same bill, in regarding the PTE extension, there was another change for estimated payment purposes. And for those who have historically elected the California PTE in the past, a 50% payment is required based upon the prior year liability by June 15th of the current tax year in order to be eligible. Obviously, for a lot of taxpayers, it's very challenging to know what federal taxable income is when that payment is due on June 15th. So rather than a disqualification by not making that 50% in the future, at least for 2026 and forward, California will now impose a penalty of 12.5% for that underpayment amount on June 15th. Now, it's not your traditional penalty that's paid to the state. It's actually a reduction of the credit that flows through to the partners. But overall, this is great news for those who elect into the California PTE and takes a lot of stress over the payments for tax departments.
Great news indeed, Ben. All right, before we wrap up, one last thing to keep in mind. With all of these federal legislative changes, state tax conformity comes to mind. While many states will automatically conform to the changes that have been imposed, there are some states that require legislative action. This is something to track and monitor. Ben and I would like to thank you for joining our Tax Insights in Brief discussion. Please don't hesitate to reach out if you have any questions or would like to discuss the state and local tax implications of OBB on your organization. Thank you.